Welcome back to Lady Africa Forex YouTube channel. Today, you are going to learn about classic chart pattern formation. Chart pattern formation in the market helps you spot where the price is and will tell you whether the price is going to continue in the current direction or reverse. Let's see, as a Forex trader, what do you do when you spot a chart pattern formation? So as a trader, there are important things to note. Chart patterns repeat over a period of time. Another thing you need to note is location of the chart patterns. There are chart patterns that appear in the middle of the trend or towards the end of the trend. So when a chart pattern appears in the middle of the trend, you know as a trader that you want to anticipate trend continuation and you're looking for signals to add more positions. Another important thing to note is the volume of the pattern. When the pattern forms with impulsive moves, then it shows that the trend is either going to reverse or it's either going to continue. So those patterns that come with big impulsive moves give promising signals for you to decide whether you're entering the trade, whether you're selling, you're buying, or you're exiting the trade. Confluence is also very important as a trader. You know you have other indicators. For many technical traders, they use other indicators such as Bollinger Bands, moving averages, or even RSI. So make sure that whatever you see, whatever chart pattern that you have identified in the market structure still complies with the confluence with the other indicators. So what are the uses of chart patterns? As a trader, you want to ask yourself, how do I find potential entry points? Remember, your business here is to look for points of interest, to look for potential signals that gives you entry points. Another question you want to ask yourself, how do I spot trend continuation signals? At what stage is the market? Is the market at the first stage? Is the trend at the second stage or at the third stage? There are some chart patterns that appear at the first stage, others appear at the second stage. So if you're already at the second stage, how do I spot trend continuation signals once the chart pattern has formed? You will have to look for your price action and look for an entry and continue collecting your pips. And then another important question, how do I know when to exit? Of course, you have a goal for the day. You know how many pips you want to collect during that trading session. So once you've achieved your goal for the day, how do you exit? And how do I identify imminent trend reversal? So if your chart pattern has formed at the third stage of the cycle, then you're looking for trend reversal. You know the market has exhausted. The price is no longer moving any lower or any higher. You have reached the peak. So most of these chart patterns form peaks. So you're looking for that peak formation so that you either exit the trade or wait for that imminent reversal and start trading towards the opposite direction. So here I have a list of chart patterns that we are going to discuss today. There are so many chart patterns, but I've come up with those classic ones, the important ones, the ones that is very easy to identify as a beginner trader. And Here they are. We have a double top, double bottom chart pattern. We have head and shoulders and inverse head and shoulders chart pattern. We have the rising and the falling wedges. Some chart patterns come in form of a wedge. So you will see the difference between a falling wedge and a rising wedge. And then we have rectangles. Another important chart pattern are the pennants. The pennants could be either bearish or bullish. And finally, we will look at the triangles. Triangles, there are different types. We have ascending, descending, and symmetrical chart patterns. Okay, so let's first start with the double top chart pattern. Here, we will start with double top chart pattern and see how that chart pattern forms, and we'll see what does it tell you as a forex trader once you see that chart pattern in your market structure. Yeah, so here we are. This is our double top market structure. You can see as you can see, this is called a double top chart pattern, which you will identify in a market structure. So as you can see, remember when we discussed about the market structure, the first thing you ask yourself as a trader, where is the price coming from? Is it coming from the low or from the high? So clearly we can see price here was coming from the low going higher. That means we are in a uptrend market structure. We are in a bullish cycle. So as price moved higher and higher, it came all the way and formed a peak here. So the double tops, they are peak formations. We can also call them peaks. So we call it peak because this is the highest price point the price has come at during this trading session. So the price came from a low point, moved higher, 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 and this was the highest price point. So it formed a peak. So this peak here is a level in the market structure. So when price touched this level, the price bounced off the level in a reactive manner. If you look at the candles that were moving higher, these were impulsive candlestick patterns. The bullish candlestick patterns were impulsive, meaning it was an impulsive move that reached the peak and then bounced off to a neckline here. So the price had a reactive move and came and formed a neckline here. Let me show you something. So the price came, formed a neckline, and then price tried to hit that peak again. So when price tried to hit the peak again, it did not go beyond that level. Price did not take out the initial peak. Therefore, this is called the first top and this will be the second top. Or this is the first peak, price bounced back, formed a neckline, then tried to hit that level again and bounced off and formed a second peak. So what happens here? It means that at this point in the market, the price has formed a double top at the end of the trend, at the end of an uptrend. So what does this information tell you as a trader? That a double top chart pattern has been formed. It's the end of this uptrend market. It's time for you to look for selling opportunities. It means this market will not go higher than this level. The support level is strong. The price point cannot move higher than that level. So what do? You look for your reversal signs. You know now this market is going to reverse. So this market is going to be called a reversal chart pattern formation. Therefore, look for your trade entry confirmations. Look at the candlestick pattern formations in that area and look to sell, because now you already have your point of interest. You know we are reversing, and then you enter the trade. And what happens after the price has hit twice this level, twice, price reversed, and you collect your pips. So if you already entered the trade at this price point here, keeping in mind that the market structure did not go beyond this level, it hit this place twice and did not take out that price, then you know you have your double top chart pattern formation. You sell and you collect your pips. So that's it with the double top chart pattern formation. Remember, now it's a bearish signal. It's telling you it's time to sell. It's found at the end of an uptrend market structure. So let's look for the inverse. What happens if you see head and shoulder in a downtrend market structure? This is now a double bottom chart pattern. It's the inverse double top chart pattern. Here, the market was coming from a high price point, pushing lower and lower and lower until it reached the peak, the lowest price point during that market session. What happened? Price hit the peak and bounced off in a reactive manner and formed a neckline, and then price tried to hit that level again and was unable to break through that price point. So what do you do as a trader? You know this is an imminent reversal chart pattern. So the chart will form the first bottom neckline, second bottom. Now it will definitely reverse. So you look for your entry signals. You look for that candlestick chart pattern that will tell you it's time to enter. So if your candlestick pattern was engulfing candlestick pattern at this price point, you look for it, you enter the trade. If your candlestick pattern is a pin bar, look for it, enter the trade. If your candlestick pattern is an RRT, look for it, enter the trade. So for those aggressive traders in the market, when they see this double bottom chart pattern, for aggressive traders, they will enter the trade here and start collecting the pips early. However, for conservative traders, they may want to wait for a retest, because definitely once this price has hit this bottom twice, it's going to break out of this area and reverse and start going higher. So for conservative traders or beginner traders, you may want to wait for the price to move and form a high, which will take out, will break this market structure at this neckline, retest, then now buy at discounted areas and start collecting the pips. So with this chart pattern, when you're looking for your trade entry signals, you're either going to enter at this point here, because you've already seen the imminent reversal, you've already seen the two peaks, you enter your trade and start collecting your pips. Or you may want to wait, because you know the market sometimes is unpredictable. It could be a fake out rather than a breakout. So you may want to wait for the market to form a high then a pullback, then now enter your trade here and collect the pips. Either way, at the end of the day, you're going to achieve your targets because you have seen the chart pattern forming towards the end of that downtrend market structure. You have known, now you're looking for reversal because this chart pattern, the double bottom chart pattern or the inverse double top chart pattern, has given you the signal that this market is going to reverse from a downtrend to an uptrend market. Okay, so we have seen the double top, double bottom market structure. Let's see another chart pattern. Our second chart pattern is the head and shoulders chart pattern. Why do we call it head and shoulders chart pattern? It's because this chart pattern formation has 3 peaks. If you look at this, market structure, price was coming from the low and formed a higher high or a high wherever it was coming from. It was coming from the low. It was an uptrend market structure. It came here and formed a peak. We are calling it a peak because this is the highest price point at this point in time. Then what happened? Price pulled back, price correction happened, and then another impulsive move came and formed another peak here, which is higher than this first peak here. So the second peak, we call it the head because it took out the first peak. Then what happened? After the second peak, price corrected again, formed sort of a neckline here and formed another peak here. So this third peak is lower than the second peak, whereas the second peak is higher than the first peak. So it has formed a shoulder, a head, and a shoulder. In other words, it has formed troughs. If you look at this structure, you can see there's a trough here and there's another trough here. So these are 3 peaks formation, with the second peak being higher than the first and the third peak. So this is a head and shoulders chart pattern. What is it telling you? That there's going to be an imminent reversal. Now, the uptrend market has undergone exhaustion. The price can no longer go higher than this price point. And the third peak did not take out. The third peak here did not take out the second peak. So price point is not going anywhere higher than this area. What do you do as a trader? You start looking for selling opportunities. We are no longer buying. What is the safest way of looking for your trade entries, especially for beginners? You wait. Once this peak has been, the third peak has been formed, and you've clearly seen it did not take out the head, price has started moving lower, price has shifted to the selling cycle, you look for your candlestick pattern that will confirm your entry. And the safest way is to wait for this impulsive move to form a lower low. A lower low that is lower than the neckline that has taken out this neckline here, and then now you wait for a retest of the price, then you enter your trade here at premium prices, because now this is going to give you a confirmed market structure, a confirmed direction that the price is now moving lower, that the cycle has changed from a buying cycle now to a selling cycle. Of course, again, this is safer for beginner traders, but definitely for those aggressive traders or experienced traders who know how to identify the head and shoulder pattern, they will of course enter their trade somewhere here. As soon as the third peak was formed here, this shoulder was formed, then this is going to be your entry and you collect pips. The difference between the first entry and the second entry is that the second entry is risk-free, and the first entry, it has its own risk because you don't know whether this price will take out the low of the price, whether it was a real breakout or it was a fake out. So for you to play safe and you want to make sure it was not a fake out, then you wait for a retest, then now you shift to the selling cycle. The reverse is true with the head and shoulders. Our next candlestick, our next chart pattern formation is the inverse head and shoulder, which usually happens at the end of a downtrend. So here we are. We can see this is a downtrend. How do we know it's a downtrend? Prices are pushing lower and lower. You can see the big impulsive bearish candles which are pushing the prices lower. Then what happens? The price reached its lowest peak here and formed a first shoulder when price was corrected back, and then the price formed a neckline. So when there was price correction, of course impulsive moves tried to hit that area again, this price point, and this was the lowest the price could go. So the head definitely took out the shoulder. The price took out the shoulder and formed a lower low compared to this shoulder here. And then once the price hit this level, it corrected again. Then the price attempted to hit that level again, the lowest point, but it was unable to take out the head, and therefore the price formed a shoulder. So as a trader, what does this chart pattern tell you about the price? It tells you that the price has reached the lowest point during that trading session and it's time to reverse. What do? You look for your entry signals and start looking for buying opportunities. So once the third peak is formed, price will shift from a downtrend now to an uptrend. How do you want to play safe with this kind of trade? You wait for the trade to break out the previous market structure at the neckline and form a high. Once the price has formed a high, you are going to wait for correction, a retest, then from there you're going to have your entry and buy at discounted areas and start collecting your pips. So this market has shifted from a selling cycle to a buying cycle. How did you know the market shifted? Is because of the head and shoulder chart pattern that formed at the end of a downtrend market structure. And that's it. At the end of the day, you are going to collect your pips because the chart pattern gave you information about the direction of the market and that the market is going to reverse. So let's look for another important chart pattern. So we have our rectangle chart pattern. A rectangle chart pattern in most cases exhibits consolidation, and in most cases a rectangle chart pattern appears in the middle of a trend. If it's an uptrend, then a rectangle chart pattern forms, then that consolidation shows you that the market is breathing for a while, but it will continue in the current direction. So let's look at rectangle chart patterns. So what happens during rectangle chart patterns? This is when price was, for example, this is a bullish rectangle chart pattern. This will happen. This will happen when the market was coming from a low price point, and now the direction is moving higher and higher. The market is forming higher highs, higher highs, higher highs. And then at some point in the market, price consolidates. And this price consolidates for some time in a box. Let me just say, if you draw a box, you see that price will consolidate between this high price point here and this low price point here. It's sort of like the price is just bouncing within this tight range for some time. And then what happens now? What do you do as a trader? Remember the sideways ranging market. When price consolidate, all you do is identify your high and your low during that consolidation phase. Then you wait and see whether the price will break out from that consolidation phase. And as you can see here, actually price broke out with this bullish candle from the initial high at that range and formed another high. So this price broke out and formed a higher high. Why are we saying it's a higher high? It's a higher high because this high here has taken out this high where there was a tight range. So this tells you now price is going to continue. In most cases, bullish rectangles always occur during the second level of the market structure. So you anticipate a continuation. You anticipate that the price will go higher. So when the price breaks out of this rectangle and forms a higher high, what do you want to do? You want to wait for the price to correct, and then now you enter the trade at discounted areas and you collect your pips until when the price now forms another high, another higher high. Then now you'll decide whether you want to exit the trade or you want to take partial profits or you want to add more position. So during this phase where the rectangle was forming, when the price was bouncing between these two price points, you had a decision to make, because keeping in mind that the rectangle has formed in the middle of an uptrend, then when you get to your point of interest, you might want to add more positions because this chart pattern is a continuation chart pattern. It has already informed you that the market will continue, the price will continue in the current direction, which is an uptrend market, which is a buying cycle. So you want to continue adding positions here at your point of interest. So that's the importance of having the rectangle chart patterns. It's a continuation pattern that forms in the middle of an established trend. So all you need to do is add more positions to the trend and collect more pips. The reverse is the same. Just like the uptrend, we also have a bearish rectangle chart pattern. The bearish rectangle chart pattern appears in the middle of a bearish market. You have your downtrend, market is pushing lower and lower, and then the price consolidates for some time. So what do you do as a trader? You just mark your high and your low of this ranging consolidation phase, and then you wait for the price to break out. Keeping in mind that the market is a downtrend market, this is a continuation pattern. So you anticipate the price to break out of this rectangle towards the downtrend direction. So you look for your signals. You look for your signals to add more positions to this trend because it's still a strong trend. What will you do once the price breaks out of this rectangle? It's obvious. It's better to wait for the price to retest here, and then now you sell at this point. This is where you are going to enter or execute your trades. This is where you are going to add your positions at premium prices, and you continue collecting your pips for the day, either to swing it all the way until the lowest point of the structure or until when you achieve your targets. So other than the rectangles, we have another chart pattern called the pennant. Let me show you the pennant. Pennants are very common. These are the most common and most profitable chart patterns you will find in a trend. So here we are, we have our pennant. This is a bearish pennant. Why do we call it a bearish pennant? Because it has appeared in the middle of a bearish market structure. You can see clearly the price are coming from the high and they're pushing lower. So what happened during the reactive moves? As the price is correcting, price decided to consolidate. Why do we call it a pennant? Is because the price is getting tighter. The consolidation is getting tighter and tighter in between this. If you draw two small trend lines, you'll find yourself drawing a triangular sort of shape. So the price is consolidating in these two tight trend lines and forming a triangular sort of like shape called a pennant. So this is just a brief consolidation during a trending trend. So what happens after the brief consolidation? Price will definitely break out downwards. Price will definitely break out downwards, and you can see the price has broken out with big impulsive moves, and this price has taken out this low and formed a lower low here. So pennants are very good chart patterns that if you can identify them, you're able to collect more pips, you're able to be profitable, and they occur in the middle of the trend. They occur at the second level of the trend. And we have both bearish pennant, the reverse is the same. We also have a bullish pennant. Let's look at a bullish pennant. This is a bullish pennant. You can see clearly. Price was coming from a low price point, moving higher, formed a higher high, and then price consolidated for some time. And as the price is consolidating, a triangular shape sort of is formed. What happens? Price then breaks out from this consolidation and forms another higher high. This higher high has taken out the previous higher high, and the trend has continued. So if you want to know how many pips to collect after a pennant, you just measure the distance between where the price was coming from before the pennant. You can see this blue arrow here. So this is the distance between the two price points before the pennant was formed. So because the pennant gives huge impulsive moves, you are sure that when you enter your trade here, you're going to get pips equivalent to the pips that were collected here. So if here these were 100 pips, as soon as the price breaks out of the pennant, you are sure to get 100 pips from this area here, and you're able to collect your profits for the day. So let's look at the wedge. How does the wedge form? You can clearly see that this is a downtrend market structure. It's a bearish cycle. How do we know? Price is moving from a high point and it's pushing lower and lower and lower. As the price pushes lower and lower, if you draw a trend line, if you draw through two trend lines at the upper side and at the lower side, touching the lower highs, this is a lower high, this is another lower high, and then this one is a lower low, this is another lower low, lower low. So when you touch these price points with a trend line and you touch these lower low price points with a trend line, they form a wedge. So a wedge is when two trend lines converge and then price points gets tighter and tighter in between the two converging trend lines. What does it tell you? It tells you that this market is exhausting. The market is going to give you an imminent trend reversal. What do you do? Once you identify your price points and draw the converging trend lines, as soon as the market hits the lowest price point, as soon as the peak is formed down here, you look for your trade entry signals. And how do you know there's a peak? In fact, with this chart here, you can see a hidden double bottom because the price came, touched this level here, bounced back, formed a minor neckline, came back and touched this point again. So here, in fact, now we've seen two chart patterns all together. You've seen a wedge as the price was pushing lower, and then you've seen a double bottom here. The price formed a first peak here, first bottom, bounced back, tried to hit this level again, and bounced back. What do? Look for your trade entry. And definitely our trade entry is here, and price has shifted from a selling cycle to a buying cycle. So the chart pattern, the wedge, which was a falling wedge, has given you a signal that we are going to reverse. Let's look at another wedge, a rising wedge. Remember, some of these patterns are used interchangeably. Some are used as continuation signals. Others are used as reversal signals. This is another example of a wedge. Yeah. So when you look at this wedge here, price was coming from a low price point. Yeah. And started forming higher highs. And then the higher lows, when you draw a trend line at the using two price points, this is one of the higher lows, and this is another higher low, and this is another higher low, and then they sort of form a slope. So there's the upper slope and the lower slope, which forms a wedge. So the price is consolidating here within the wedge until it reaches a certain price point where it breaks out of the wedge. So as a trader, you are looking for that breakout, and you're looking for your trade entry signals at your points of interest. So what happened to this wedge? Price was moving higher and higher. It was an uptrend, but then at the end of the wedge, price broke out to the downside and shifted to a new cycle, a selling cycle. Remember, if you're an aggressive trader, you definitely will look for your entry signal and trade the breakout. However, for conservative traders or beginner traders, you're advised to wait for a retest. Anytime price breaks out of a certain point, you wait for a retest. So this was a breakout, and we can know it's a breakout because of the impulsive moves, impulsive bearish moves. So you wait for the price to give you a retest, then you enter and continue selling. So this is a rising wedge, and it gave us a reversal signal. Price was coming from a buying cycle, but then shifted to a selling cycle. Additionally, we have triangles. Triangles are also very common chart patterns in the market. There are different types of triangles. We have ascending triangles, descending triangles, and symmetrical triangles. So let's start with the ascending triangle. This is an example of an ascending triangle. So in triangle formations, you will see at least 5 touches of price on the support and resistance areas. So for example, with this triangle formation, you can see price was coming from the low and price was pushing higher and higher. And then there's a level here, which is a resistance level. So price will touch this level at least 3 times or sometimes even twice. And then if you draw a trend line, the trend line also acts as support resistance. So this trend line here will act as a support. So you will see price touching the support at certain price points. And when you count, there could be either 3 or more, 3 or less, or vice versa. So the price can touch the resistance areas twice and the support areas 3 times, or vice versa. So in our case here, let's analyze this triangle. Price is coming from the low, which means we are on a buying cycle. Price is coming from the low. It's an uptrend market. We are buying, we are buying, we are buying. Then what happened? As the higher highs are forming, as the price pushes higher and higher, the price will reach a certain peak or a certain resistance level, which is now represented by this green trend line here. So what happened? Price came, touched this price point, then it was corrected. And then what happened again? Price came back to the same level, formed another peak, and then bounced off that peak. So it did not take out this level. It did not take out this resistance area. So that means the resistance area here is very strong and price is unable to break out of the resistance area. Then price touched the third time here and failed to break. So what happened? Price shifted. So this is a reversal pattern that forms at the end of an uptrend where there are peak formations. So this is actually a peak formation with three touches on this same price point. So what happens? Price failed to break out of this area and shifted to a selling cycle. What do you do as a trader? You definitely will identify this chart pattern and you will know it's a reversal pattern. It's time to look for signals. So you enter your trade. How do you enter the trade? You look for the price point where the price has shifted from buying to selling. Of course, the advice is the same for beginner traders. What do? You wait for a retest. How do we know there's a retest in this chart here? The price moved impulsively out of the resistance area and formed a lower low. This lower low took out the neckline of this structure. So this lower low broke the previous market structure and initiated a new market structure. What do? You wait for a retest here and then you sell and collect your pips for the day and achieve your targets for the day. Same applies with the other type of triangle. Let's look at the other triangle. It's here. This is called a descending triangle. Why do we call it descending triangle? It's because the market was coming from a high point and pushing lower and lower. So how do we know? Because we can see this impulsive moves. The bearish candles are impulsive and they are pushing the price lower. Then what happened? Price hit this support area and failed to take out. So price touched the support area at least 3 times. This was the first touch, this was the second touch, and this was the third touch. And during these touches, price failed to break this price point. So price could not go lower. So what do? You draw your triangle to see how many touches are there in this support area and to see what kind of triangle you're going to form. Here you're going to form a descending triangle. What do? Look for your trade entry. Which direction are you anticipating this trade to go? Definitely now you're looking for the price to break out and form a new cycle, which is a buying cycle. So you'll wait for the candlestick pattern here that will confirm. Once price breaks out of this area, then you wait for a retest and then you buy. And you buy and collect your pips for the day. So this is a very common chart pattern that happens towards the end of a trend. However, remember I said there are some chart patterns that form at the beginning and others form at the end of a market structure. There are some chart patterns that can be used interchangeably. Some can be used as continuation, others can be used as reversal chart patterns. Let's look at the final triangle. The final triangle is called symmetrical triangle chart pattern. Why do you call it symmetrical? Is because when you draw a trend line, when you draw 2 trend lines, they converge at a certain price point and the price, the high and the low, the distance between the two price points is equal, so the triangle is symmetrical. So this is usually a chart pattern that is very common, and it can break in either direction. Since it's symmetrical, it may break in either direction. So let's see what happens here. This is a price that was coming from the low. This is our price point. You can see impulsive moves here. The green bullish candles are impulsive. So price was coming from the low, pushing higher. So we know that we are in an uptrend market structure. Then during consolidation, the consolidation pattern formed a symmetrical triangle. So you're not able to know which direction this price will break out. It may break out in the upwards direction and continue with our uptrend market structure, or it may break out on the reverse side and change direction. So as a trader, what do? You wait for the breakout. In this situation, you wait for the breakout so that you know. And once the price breaks out, this definitely we can see the price broke out to the lower side. What do? You wait for a retest, and then you continue with your selling cycle. Why do we wait for a retest? Because we know sometimes the breakout might not be sustainable. It could be a fake out. So you want it to be a confirmed structure. If it has broken out to the lower side, you want it to be a confirmed bearish market structure for you to start selling at premium prices. Same happens with the opposite side. If the price broke out towards the high, then price will form a higher high. What do? When the price forms a higher high, you wait for a retest here, and then now enter your trades at discounted areas. So it's that simple. All you need to know is how to identify the chart patterns, how to draw your trend lines and see whether it's a symmetrical chart pattern, whether it's a wedge or ascending or descending chart pattern. So let's move to the next chart pattern, which is a flag. Mostly flags are very common trend continuation chart patterns. Why do we call it flag? It's because when you draw the two trend lines during the consolidation phase, the trend lines are parallel to each other and the distance between the two trend lines are equal. So they don't converge. That's why they are called flags. So you can have either a bullish flag or a bearish flag. So let's see what happens. So here I have examples of both bullish and bearish flags. With this bullish flag here, this is the first flag, then this is now the second flag. With this bullish flag chart pattern, you can clearly see market was coming from the low. It was an uptrend market structure. We were buying. And then what happens during the correction phase, during the reactive movements, all you need to do is draw the flags, the two trend lines that form the flag, and wait for this consolidation phase to end. What happens when the consolidation phase ends? The price, you anticipate the price to break out from this flag. How do you know the price will break out from the flag? You are going to see an impulsive candlestick pattern, and you're going to see impulsive moves that will push the price higher. So what do you do when the price breaks out of this trend line? Here we can see we have this bullish candle that broke out of the upper slope, the upper trend line. So as a trader, you know we want to continue buying because price has broken out of the flag. So the price will break out here, form a high, retest, and then push forward. So what do? You wait for correction of the price, you wait for a retest, you enter here at discounted areas, and because it's a continuation chart pattern, you're going to add more positions to existing trades, or you're going to hold on to the existing trade. Probably you entered this trade at this point, and now this chart pattern has told you the trend is going to continue. So then you're not worried. You'll continue holding on to that trade because you know it's a continuation chart pattern. The trend will continue and you achieve your targets for the day. Same applies to the bearish flag. The bearish flag is here. How do you know it's a bearish flag? It's because price was coming from a high price point and pushing lower and lower. How do we know that? We can see strong, impulsive, bearish candles coming lower and lower and lower. Then what happened after this low? Price consolidated for some time. During this consolidation, a flag chart pattern was formed. What do? You wait, because at this point the price is ranging between these two price points. It's sort of a ranging market. So you wait for the market to break out, the price to break out of this tight range. Then what happens? You can clearly see price broke out to the lower side. Price came from a high to a low, consolidated, and then broke out and continued pushing lower and lower. How do we know that? These three impulsive bearish candles that have moved out of this area with big volume. Remember, we talked about the volume, that the volume is important. When the price breaks out of the tight range with a big volume, you know this is a breakout. What do? You wait for a retest. So this price broke out and formed a lower low. This lower low is lower than this one. You can see it took out this previous lower low. So the price will come, form a lower low, retest, and your entry point is there. You collect your pips. So when you see flags, you know we are going to continue with this downtrend market structure. You anticipate for your signals to enter more positions and collect more pips for the day. So I hope you've learned the important chart patterns. Remember, there are so many chart patterns, but these are the most important ones, and they are easy to identify, especially for beginner traders. These chart patterns can be easily identified as the market structure forms. So I have a summary here of the classifications of these chart patterns. You will notice some chart patterns have dual purposes. Some can serve both as reversal or continuation, depending with the location of the chart pattern, whether it has formed at the beginning of a trend or in the middle of a trend where the trend is well established. You know we are moving either up or down, or towards the end of the trade. So we have reversal chart patterns. You can see double top, the heads and shoulder, the rising wedge, the double bottom, the inverse head and shoulder, and the falling wedge. Those are reversal patterns. And then we have continuation chart pattern. You can see the falling wedge is also a continuation pattern. So there it has served two purposes. It's here as a reversal chart pattern and also as a continuation chart pattern. And then of course we have the rectangles and the pennants. And then we can have bilateral chart patterns. These are chart patterns where the breakout can be on either side. It can either break out on the upper side or on the lower side. So remember, when you're dealing with bilateral chart patterns, the triangles, which especially the symmetric triangle, which can break on either side, you wait for the breakout to complete, you wait for a retest, and then you now take the trades. Either if it's going higher, you take it at discounted areas. If it's going lower, you take it at premium areas. So that's it for today. I hope you've learned something. Please take your time and master these chart patterns, because they are going to make you a profitable trader. Thank you for watching. See you in the next video.